Okay, welcome back to another video. I talked in my last video about put credit spreads and how I started dabbling in them just to get a feel for them, how you can trade put credit spreads and how you can open them, how you can close them, what's the difference between that and just selling puts, and really it was just learning experience. I probably picked the worst time ever to test out selling put credit spreads just because of how the market's been performing in the last week or so. And let me bring up my spreadsheet. I also talked about this. So far, I'm in the red this month when it comes to trading options, and that's because I was selling put credit spreads on AMC, and AMC tanked, and I got scared. I had to buy to close this position, and unfortunately, it was a lot more expensive than the amount that I got in it, and or the amount of premium I got from it, rather. So that's why we're looking at negative $93 so far this month, and I have a couple more put credit spreads open right now. We'll see how the next couple weeks play out. One with Astra, one with Palantir. And my best guess is I'm probably going to lose money on those, but that's okay. To me, this is a learning experience. Maybe I don't ever want to do this again, or maybe once the market settles down, this can be a strategy that I can use. And I did successfully open and close a put credit spread. I did it on SPY, or the S&P 500 ETF, and I made $40 in premium, and I closed it paying $5. So 40 minus 5, 35. That's how much I ended up making from that trade. And if you want more in depth, I'm not going to go too in depth because I don't really know all of the intricacies of put credit spreads. I'm just going to show what I've learned so far with you guys. But if you want to go more in depth, I recommend checking out Invest with Henry. This video in particular is Palantir put credit spreads. Is the first video I watched and even learned about put credit spreads. I didn't even know they existed, and I watched this, and maybe when you're done with this video, you can check out this one too. So what's the significance with put credit spreads? Well, unlike selling puts where you have to have sometimes an enormous amount of collateral, you can sell put credit spreads which require less collateral to get in the trade. They are less risky, but the trade-off is if the price of the underlying stock goes in the money, you don't have the option to buy those underlying shares, those 100 shares that you would if you were to sell a put. And to me, that's kind of the downfall because I'm not the best at timing the market, obviously, but if I can buy the underlying shares that I like the company anyway, then I'm okay with holding on to them and just seeing what the stock does in the long term or in the future. And then I can sell calls on it and make some extra premium that way. With these, you have to pretty much just say, okay, I don't think the stock is going to go below this value. So let me show you an example of a put credit spread. And by the way, if you're wanting to look at this on your own in Robinhood, you have to enable it in your account. This is, I think it's called like level 3 options trading. So you'll have to get that enabled before you're able to trade put credit spreads. So let's do it on AMC. Let's look at the stock of AMC and let's trade options on it. So the first thing, as always, we want to pick an expiration date. So I'm just going to pick next Friday, and I'm going to sell a put, which you're probably familiar with by now. And let's say we go down to the $25 strike price. Let's say in my head, I am a technical analysis genius, and I say, I don't think AMC is going to go below 25 by next Friday. So I go ahead and I sell that put. If we look, here is our profit and loss. Our loss can be all the way to $2,381 because it would be $2,500 minus the premium that we get, so $119. That's the amount that we can lose because the stock could potentially, not very likely, but it could potentially go all the way down to zero. Therefore, we lose all of the money. But what's nice about a put credit spread is that's impossible because we also will buy a put at a strike price lower than the put that we sold. So let's say I sell a put at $22.50 and this cost me 73 cents per share, so $73 total. My expected loss is only $203. We'll talk about how we get that here in a second. And our expected profit, if everything goes right, if the stock stays above $25, we will make $47. And Robinhood has this nice little visualization so you can see, how much you could make and how much you could lose. And how they get $203 is the difference in strike price. So this is 2,500 and this is 2250. The difference, and let me get a calculator going. So we do 2,500 minus 2250. That gives us 250 difference between these two strike prices at 100 shares apiece, minus the amount of premium that we get. And the amount of premium that we get is 119 minus the $73, because this is what we paid to buy this put. And if we do that, it's $47. So minus $47 is $203, and that's how we're able to potentially lose $203 total. But that's better than losing whatever I said before, 2,300 or whatever it was. So here's the thing. Like I said, it's less risk, but if the stock goes below the put that we sold, we do not have the option to buy those underlying shares. Now, if I wanted to, I could sell to close this put, and then I would have to have the collateral to buy these shares if it did go under. But I'm just strictly looking at this put credit spread. So we'll get 46 or 47 bucks in premium, and we'll hit continue. If we wanted to open this position, we'd say, give me one contract. We'd review it and then proceed to purchase it. And then if we wanted to close it, so here's one that I'm currently in the red on. I ended up doing a put credit spread on Palantir. $20.50 was the strike price that I sold the put at, and $19.50 was the strike price that I bought the put at. Right now it's at $18.90, so it's not looking too good, and I am down $47, and I made $24 in premium off this. And opening and closing, it's pretty easy. We can just say, I want to close one of these contracts because I only own one. Here's the price that I'll close it at, times 100, so $71. It'll cost me to close this. So in a perfect world, if this got down to, like, let's say 0.05, so times 100, that'd be $5. If I could sell it at that price, then I would make $19 in premium from this trade, and I'd be happy. But as of right now, I am in the red, and that's what happened to AMC. AMC just kept going down, and I got scared, and I went ahead and I just closed that position at a loss. So far I haven't been, like I said, too lucky with put credit spreads, but I did probably pick one of the worst times to go ahead and dabble with those. So maybe in the future, when things settle down, this could be something to consider, because you can go way out of the money and do this too. You'll make less premium, but you can go way out of the money, so it's less likely that these will be worthless. But right now, I'm just going to hold back on doing this for a while just to see if the market settles down some. So that, I guess, is the basics, according to me, of put credit spreads. Like I said, you can check out Invest with Henry and see his videos on it. He has more than one, I'm sure. And yeah, if you like this stuff, subscribe. That way you can follow along with whether I make money or lose money selling puts on the side, and hopefully learn from my mistakes. And I hope to see you guys in the next video.